Following program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared in the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
We are here on The Answer About Money. How about that? I like that idea. The Answer About Money. KLFE 1590. So today we've got a lot of things to cover, a lot going on right now. So let's get started. I've got a very great guest coming. He's got a great story to tell. So you want to hear what he has to say? And there's lots of information today. There was a poll that was done in June. I just actually read the poll this last week. I was looking through some other information, found the poll. It was put out by Nationwide Retirement Institute. They did a poll of a little over 1,000 people, and found that only 25% of women expect a better life after they retire. Only 25% of women expect a better life after they retire. 26% expect life is going to be worse, and the remainder think life is going to be about the same, but could be worse. You know, when you look at it, that's not a very nice thing to look forward to. 18% of those who were polled are going to depend strictly on Social Security, which means 82% have supplemental income. They have a retirement, they have a defined benefit, they have a defined contribution type program, they have a 401k in some fashion. They have retirement income coming in. And it included government people as well as private individuals. And with the government programs, most of those are defined benefit. So that had to be a significant portion of the 25% that felt life was going to be at least as good or better. That means that a lot of women feel that life is going to get worse once they retire. So it was actually 1,012 people. And I know some people have asked in the past, why just 1,000 people? And I thought, I want to divert a little bit, talk about polls, talk about why 1,000, because you very often see polls are done with just 1,000 people, and they're fairly accurate usually. I know, during the last election, the polls weren't too accurate, but that's another story. You know, when you look at it, most polls are around 1,000 people. Usually they get a few more than 1,000 people just to be sure that they're there. And I want you to think about it in terms of numbers, because I am a mathematician. I look at the numbers. So if you're flipping a penny, you have a 50-50 chance when you flip a penny that it's going to come down heads. 50% chance it's going to come down tails. Half the time it's going to come down heads. If you flip that same penny twice, 1/4 of the time it's going to come down 2 heads. 1/4 of the time it's going to come down 2 tails. And half the time it's going to come down a head and a tail. Pretty straightforward, right? If you flip the penny 3 times, 1/8 of the time it's going to come down 3 heads. 1/8 of the time 2 heads. You get the idea of what I'm saying. 4 times 1/16. 5 times 1/32. But as you do more and more you get an equal number of heads and tails, right? If you flip that coin 1,000 times, how many heads are you going to usually come up with? Around 500. Maybe it's going to be 507. Maybe it's going to be 491. But it's generally going to be in the range of 500. If you flip the coin 1,000,000 times, how many are you going to get? About 500,000. You know, you might get a few hundred off one way or the other, but it's going to be right around that average. That's why you use a poll of about 1,000 people, because you come up pretty close to the average. And when they do a poll, you can see the consistency of the poll because they'll give you a +3 or +4% error. That's because when you flip a coin 1,000 times, you're very seldom going to come out with exactly 500 heads. You're going to come up with 503, or you're going to come up with 485. So there's a variance around that average. And that's why they say the poll has an average variance or an average dispersion of 3%. So as you look at this, you can say with 1,012 people polled, the chances are very, very good that those numbers are pretty accurate. It might be 28%, it might be 22%, but it's right around that 25%. Now, the other thing that happens, so there's been a lot of things that have arisen about polls, and you can't trust polls. Think about it. Think about what happens if instead of flipping a penny, you flip a quarter. You're going to expect the same results, right? If you flip a quarter 1,000 times instead of a penny 1,000 times, you're still going to expect it comes out about even. But now suppose you paint one side of that coin with a paint. So one side, on the head side, it's heavier. Now you're going to distort that 50-50 chance. So when they were doing political polls, you look at what went on before, and you try to assess with the polling you do, you try to correct that poll for the paint on the coin. You know, what we saw with the most recent polls in the presidential election is there were differences that are taking place. My guess, as just a side note, is if the March for Our Lives and the Women's March comes out, it's going to distort the polls again coming up to midterm elections. But that's another program. We have to get to that another time. I want to come back to this whole idea that so many are concerned that they're going to run out of money. And while the poll was done for addressing women, the poll included men. And the fact is, while there were fewer men that were worried about running out of money, there were fewer men that were worried they were going to have a worse time of life. The fact is, most of the men felt the same way as the women did. The numbers were slightly different, slightly more favorable for the men, but not all that much. You know, when you look at where we are today, when you look at where we are in terms of our living, in terms of our incomes, in terms of where we are in retirement, 30% of all 50-year-olds today are going to see 90 years of age. And for the affluent, for the higher earners or the more wealthy, 50% will see the age over 95. That means a lot of us are going to turn 100. And if you look at financial planning, and I did a whole series on financial planning, the problems with financial planning, what was wrong with it. If you begin to think about that, a lot of financial planning programs are only geared to people living to age 100. Now, if 45% of us are going to live to age 100 and then run out of money, we have a problem. We have a definite problem. So, you know, what also raised all this up is because a competitor talked to one of my clients. They looked at her portfolio and said, "Oh, you have too much in stocks. You're too heavily in stocks." You know, in fact, she was 100% in stocks. And in fact, she's in her 70s. And looking at old-time financial planning and portfolio planning, you'd expect her to be 70% in bonds, 30% in stocks. But here's the story. Those formulas came up 25 or 30 or 35 years ago. And what was true then is no longer true. My father actually died at age 61. And he was looking at his retirement plan, and he could have retired, and there was a 5-year annuity for his pension. 5 years. Because when you get to be 65, when my father was living, most people didn't live for those 5 years. I mean, think about it. The average life expectancy was much lower. Every year, life expectancy is increasing by 3 months. Every year that we go, for a person turning 65, the life expectancy is increasing 3 months. What that means is we need more money. I'm going to come back and talk about the comparison I made with my client and my competitor who thought she needed more fixed income. If she would have taken my competitor's advice when she came to me in 2010, she would be on the verge of not running out of money now, but very, very much in her 90s, a big risk of running out of money. I don't want my clients to run out of money. I don't want my clients to worry about running out of money. My clients went through 2007, 2008, and some were retired, some were approaching retirement. No one, not one, expressed any concern about having enough money that they were worried about running out of money. That's what I want my clients to feel. We're coming up to a commercial break. Don't go away. We've got more to cover, and I want to finish up here this whole idea. Why should you have different portfolios? We'll be back right after this break. Don't go away. I'll be right back.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I've been talking about people that are concerned about running out of money, and it brought it to mind because a competitor talked to one of my clients and said she had too much in stocks. She had 100% in stocks, and she's in her 70s. She came to me. She had just turned 70 or a little, maybe 71 in 2010. She had approximately $2 million, and she needed $150,000 income. With what she had going on, that's what she needed a year. So she needed approximately 7.5% a year. That's fairly significant, but she had a fairly significant living style. She didn't want to run out of money. She didn't want to reduce her living style if she needed to. And as many of my clients have been, they've been to other people, and she'd been told that there was no way she could take out $150,000 and maintain her principal. Well, today I said, I think I can do that. I've been doing that for other clients. And today she has $3.4 million, and she's taking out $250,000 a year. So she's increased what she's taking out, and there's some reasons why she's taking that out. It's not just she decided to increase her living style, but there's some medical things. There's some other things that have gone on. She needed more cash out of the account, and so she's been able to take that. Had she had 70% in bonds and 30% in stocks, today she'd be really concerned about having to reduce her lifestyle, her quality of life, or running out of money. I did a chart. I showed a chart, the difference between what I do, and we posted the chart on the website, I think. Right, Sarah?
Yes.
It's posted on the website. What's it posted under?
It's under blogs.
It's under blogs, entitled,
I believe, Is Investing Right for You? It'll be the first one up.
Is Investing Right for You? Okay. So Sarah's here. Sarah's tweeting. Anyway, Sarah is our administrator. She's marvelous. She's organized. She makes things happen. She's incredible in the office. So anyway, she's here tweeting. And she posted the thing that I made, this little graph. And it shows two things. It shows one thing of what the performance since around 2010 has been with stocks and what it's been with international, and that's domestic stocks, what it's been with international stocks, what it's been with bonds, what it's been with real estate. And if you look at where things are, you have stocks that have mounted up and almost tripled, and everything else has gone up about 40 or 50%. That's where things are today. The second graph shows a line which starts in the lower left-hand corner and goes to the upper right-hand corner. I cut this out of a magazine, Futures magazine. I don't know if it was 89 or 90 or 88. Maybe it was 87. It came out of that whole October 19th, 1987 drop, and it says, long-term investing looks good, but then it gives you a magnifying glass and says, up close, it can be terrifying. And when you go through a 2007, 2008, when the market drops like that, it is terrifying. It's really worried. But if you have built up a sufficient cushion, and if you're looking long-term, that's a positive thing as going forward, because you have enough of a margin that you can take a correction or even a bear market for a while. That's the focus of where I am. That's the focus of where I am with that client and with other clients, to make sure that they have enough money that they're not going to become poor again. And as I was preparing my notes for this, I began to think, I'm beginning to sound like the annuity salesman. Annuities are sold on fear. Lock it up. Make sure you don't run out of money. You're going to get this forever. I agree with Ken Fisher. I'd rather die before I sold an annuity. The returns are terrible. I want positive returns. That's what it's about. That's the value proposition at Adams Financial Concepts. I want positive returns, and I want excellent returns. That's the whole thing. And I don't sell annuities. I'm not insurance licensed. I was at one time. And as soon as I began to dig into annuities and look at the returns and look at what was going on, I dropped my license. And I said, I'm not going to ever do one of these again. But anyway, there's one other thing that goes on. And there's a game that I've used several times to illustrate this whole thing. People in general are twice as reluctant to lose as they are happy with gains. There's a game that's been set up a number of times where people start with $20 and they have 20 plays. And it's based on a coin flip. It's like investing $1 each time the coin is flipped. And when the coin is flipped, if it comes down heads, you get $2.50. If it comes down tails, you lose your dollar. So the best way to play the game is to play every single time, because your chances of making money, you'll end up with, on that $20, you'll end up with almost $30 instead. But many people, after they lose a couple times, quit playing. Even though the odds haven't changed, they're still 50-50 every time that coin is flipped. If you lose a couple times in a row, you quit. There's only a 13% chance with those kind of odds that you'll ever be losing money. A 13% chance. The odds are 50-50 that you're going to be at $30, not $20. You're going to make $10 on that. And yet, so many people quit. The experimenters found that only 58% of the time do people play all the way to the end. Only 40% after 2 losses in a row. They quit. Even though the odds haven't changed, even though it's there. People have an aversion to loss. So when you look at that graph on the website, when you look at up close, it can be terrifying when the stock market goes down. That's where people focus. And there's a time when people need to be in fixed income. They need to be out of stocks, partially or completely. If you need the money for college, it's coming up. You have a child that's 2 years away from college or almost ready to start college. That's money that you need now. if you're putting that money away for a down payment on the house, when it comes time to buy the house, you don't want to take stock market risk. You want to lock up the money. You want to be sure that it's there. But if you have 4 or 5 or 10 years, the risk is really worth the reward. It's where you are in the spectrum. If you have a short-term need for a significant portion of that cash or of your portfolio, then you need to have fixed income to cover that need. For the client that I mentioned before, the example where she was taking 7.5%, that's fairly significant. Very few people are able to accomplish that. But 7.5% means there's still a significant portion of her portfolio that's working all the time. Now, if she needed 30%, you can be sure that the portfolio would be structured very, very differently. There would be 30% in fixed income. No way to lose that money. And depending upon what she needed beyond the 30%, that would also determine what the portfolio would be. But to say that being all in stocks is too much risk, I think there's too much risk not to be. There's too much dependence on poor performing asset classes with the idea that it's reducing risk. It does in the short term, but in the long term, you really increase the risk because you lose the margin of safety. Anyway, I don't need to sound and sell on fear or to be talking about fear, and yet I think it's an important thing to understand because people have this concept. Having too much in stocks is too risky. I think there's a time. It depends upon needs. It depends upon the individual clients, and depends upon when they need to cash out, how much cash they need out, and what the conditions are in the market. Too often, I saw during 2007, 2008, clients who had, or not clients, but people who became clients who either had too much in stocks at the wrong time or who had too little in stocks at the wrong time. Those people both suffered. It's being at the right place at the right time and having the right portfolio. Anyway, that's enough about that. I want to introduce my guest today. He's got a story to tell, and we're not going to have much time before the commercial, but we'll get started. Rick Antizana of Dynamic Language. Welcome to the program, Rick.
Thanks very much, Mike. Great to be here.
So why don't we start with your background, and we'll get to a little bit of your background. We'll finish up after the commercial.
Sure. Just basic background. Certainly, I'm from the area. I'm from Bellevue, Washington, kind of South Bellevue. Grew up a little bit in Renton, a little bit in Seattle, but most of my life was in Bellevue. Went to Newport High School and ended up at the University of Washington after that. And I think what we're going to talk about a little bit more is my business, and that's Dynamic Language. And I started that career right at the tail end of my last couple of years in college. And it's a family-owned business, and I guess we'll probably get into more of the details about that after the break.
We're going to. And your family came from?
From Bolivia, actually. Both my parents were born and raised in Bolivia. They both emigrated here back in the 60s, so a long time ago. My father was a diplomat. He was the consul of Bolivia here in Seattle for over 40 years. So he was the longest-standing consul for a long time, and my mother was a linguist. She taught languages. She speaks and reads and is fairly fluent in 4 languages, so that's something that was a lifelong passion of hers.
Some of us aren't fluent in 1 language, let alone 4.
No,
anyway, we're coming to a commercial break. We'll be right back after this commercial break. Don't go away. We've got a lot to do, and if you miss any part of this program, it'll be posted before the end of the week on our website. So don't go away. We've got a lot to cover.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I'm here with Rick Antizana of Dynamic Language. We just got started on your background. We just got almost to business.
We did.
Your parents had come from Bolivia,
Mm-hmm.
the Consulate General
Right.
of Bolivia.
Exactly.
So you had that background.
Mm-hmm.
And you were born in the U.S.?
Yes, I was the only one in my family that was born in the U.S. My sister, my older sister, was born in Bolivia as well, but she was just, I think, 2 years old when my parents moved to the Seattle area, and so they all became citizens eventually. I think she was the first one to go ahead and take care of that, but she had a really similar path to me. She ended up at the University of Washington, and we both ended up in the business. It's funny because we each considered a lot of different options as far as careers, but it was really through the encouragement of our parents, and really, I guess in one case, especially with my dad saying, "Hey, we need you, so guess what? This is what you're going to do." And we considered all these other options, but what it came down to is, from an entrepreneurial standpoint, being able to participate in a business and have a definite, tangible effect on the future of that business. And having more control and more ability to make the career what we wanted it to be. I think that was the driving factor for both of us, and we've really enjoyed, gosh, and how long has it been? Coming up on 28 years, I think, for myself, and even longer than that for my sister.
So let's talk about the business.
Yeah.
Dynamic languages.
Mm-hmm.
So tell us what Dynamic Languages is.
Happy to. Yeah, Dynamic is a business that was founded in 1985. My parents were the two founders, and it's a business that helps organizations to communicate. And it's communication in over 150 languages professionally, doing services like translation, interpreting, voiceover work, narration, transcription, transcreation, localization. There's a few dozen services that we offer in all of these different languages, and it's something that it's a bit of a niche industry. It's not like every business has a need for language services, but any business that has global partners, global customers, that has a presence in other countries, it's important to be able to communicate in a professional manner, and we help them do that. And of course, even beyond global businesses, you also have to look within the United States, which is becoming increasingly diverse, as we're all well aware of, certainly in the Pacific Northwest. And customer and organizations, even state and local organizations that need to speak with constituents that are really English as a second language, limited English proficiency people that speak Spanish or Vietnamese, Russian. There's millions of people in the United States that don't speak English as a first language at home. And so we help all of these different kinds of organizations to do that at a very high level. So,
I've done a number of programs. For a number of years, I've been talking about a super cycle, when the world GDP grows at a faster rate than average.
Right.
And the third super cycle began in 2009, according to a study done by a UK bank.
Mm-hmm.
And it's driven primarily by emerging nations.
Right.
And the forecast is that by 2030, 93% of the world's middle class will live in those emerging nations.
Wow.
That's
amazing.
Businesses, even that are domesticated here in the U.S., are competing on a worldwide basis.
No,
and so they have to compete in native languages.
Oh, it seems absolutely true, just based on what we're seeing in the current business climate and the growth overseas. So many. Just think about a lot of our local Seattle-based businesses that are in. A great example, Starbucks. I think they're in over 70 countries now. Costco, similar situation. They realize that the buying power overseas is massive. It's limitless. And so many companies that have been incredibly successful in the United States and North America in general, why wouldn't they want to duplicate that success outside of the borders and to take what's working, what's existing, and adapting it? And that's the key thing from a linguistic standpoint. You can't just carbon copy everything that you do and think that it's going to work overseas. You do have to adapt it. You have to think about your target audience, and that's what we do is we adapt content, that language, and we make it so that it's understood exactly as it was intended to be. And sometimes it's a new service called transcreation. It's something that we've been doing for years, where you almost have to just take that original, especially for marketing and advertising content, you take that original inspiration and really redo it and express something in a completely different way that gets to the main point, that takes the brand in mind and really expresses what the idea behind that original concept was in all the different target languages.
And there's a lot of mistakes that we've made over the years.
Oh, nobody's perfect, that's for sure.
I'm reminded of an old thing that I heard once. Somebody was talking to somebody from China and said, "So is it really true that you have bird's nest soup?" The Chinese person said, "Yes, it is." He said, "Is it really true in America they eat hot dogs?"
I don't know if they took it exactly as meant, right?
Yes.
There was a Kentucky Fried Chicken ad, and you're familiar with the catchphrase, finger licking good. When that was originally translated for the Chinese market, it was like, so good you want to eat your fingers or something like that. So, when you directly translate something, some things can get lost in translation, as we're aware. But no, that's why you got to do it professionally.
Yeah, it makes all the difference in the world, because if you just do a normal translation, you come across as being very American.
Yes, yeah.
And while a lot of people really like America, they really want something that they understand.
Absolutely. Yeah, you think about decades ago when consumer electronics like VCRs and things like that came with instructions that Americans would laugh at because they were just poorly written. The English did not read as something that was written in the United States, but that has changed for the most part, and I think manufacturers both overseas and within the United States are doing such a better job of taking the translation part seriously and including that in their process, not just as an afterthought, but as a planned step, so that their customers do see that they put some thought and effort into it and do a great job.
So let's talk about when somebody comes to you or they're starting to sell into a different country.
Sure.
Or they've written an app and they're suddenly finding that they're getting orders from different countries.
Right.
And that's happened. Any number of people have been on the radio program that have talked about launching an app for U.S. market and finding that they're getting orders from overseas.
Sure.
So they begin to realize that they've got a market overseas. So they come to you, and how do you handle that?
How do we help them out? It's a great question, because I think software localization is a huge growing area, and it's really kind of a low barrier for entry too, especially when you think about developers within the United States. Again, they've got a pattern, they've got a history of success with their app within a very comfortable English-speaking market, but they see potential outside of it. They're getting communication from maybe people in Western Europe. Often that seems to be a great starting point for a lot of efforts like this, where you take the FIGS languages, as they're called, French, Italian, German, and Spanish. Those are really, in a lot of cases, they're so similar to English that it's easier to localize into those languages. So what we communicate to them about is, okay, where do we start? What are all the aspects of the software that need to be addressed? Is it the user interface, help files, the marketing content, everything that's related to it? You have to just basically plan it out. And it goes from a quotation standpoint. Okay, so what's the budget? What can we do from a time frame perspective? Maybe right now it's best just to tackle, like I said, Western Europe, or for the right company and maybe something that's not as complex, you can launch in 30 or 40 languages at the same time. So that's something that we take a lot of pride in, is helping to foster that process and help people to understand what the whole thing looks like from start to finish, and then execute on what that plan is. So
the services you say you have 150 languages, but you don't have 150 different people.
We don't, no. That would be a real challenge for some of them if we only had one person for each language. There are some languages that are extremely rare, and I would say here in the Seattle area, we've got, because of the refugee and immigrant population, a good example is a language called Kunama. There are a grand total of 100,000 people, only 100,000 worldwide that speak that language. But some of them, through immigration, end up here, and so they still need help. So a big part of what we do is to find the right resources, vet them. And so, to answer your question, we have over 3,000 people that we work with on a regular basis that help us support all the different needs that our clients have.
That's awesome. So if somebody would like to get a hold of you, how would they do that?
Well, probably the best and quickest way is our website, dynamiclanguage.com. And if not, certainly we're a human company. We're happy to talk on the phone, and the phone number, our main number is 206-244-6709. We don't do answering machines and services and stuff. We're all about human connection.
And in different languages, you'll answer too, right?
That's absolutely right. You got it, Mike.
So give us the number once again.
It is area code 206-244-6709.
And online they can reach you how?
At www.dynamiclanguage.com.
That's great. Thanks for being on. It's really a crucial thing that's happening today. We have globalization. We've had globalization for a long time. Right. But today, a lot of the purchasing is done outside of this country.
Yeah, very true.
And unless companies have that real reach, they're going to find they're outcompeted by someone else in a different country.
Exactly right.
Okay, we got more to cover coming up, so don't go away. We're coming to a commercial very soon. We've got a lot to cover. Don't go away. I'm going to talk about a court case that just came out.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So it's happening again. It's happening all over again. So during the Obama administration, the Department of Labor came out with the Fiduciary Rule. The Fiduciary Rule, it was called. It was 800 pages long. It wasn't a single rule, a single sentence, 800 pages long. But there was a lot of pushback. There was a tremendous amount of pushback from the brokerage houses, from the banks, from the insurance companies. There was a study that showed that it was costing participants in 401k plans $17 billion a year. That's what these banks and brokerage houses and insurance companies were making from the 401ks on the backs of the participants. The participants weren't getting the money. The banks, the insurance companies, and the brokerage houses were. But $17 billion is not chump change. That was something that the banks and the brokerage houses and insurance companies have been fighting ever since that rule was passed. And during that time, there were a lot of letters and a lot of phone calls and a lot of emails that went into senators and congressmen and into the agency in favor of the Department of Labor rule. There were a few meetings, maybe 70 meetings. I can't remember the number off the top of my head. In-person meetings. And it almost stopped the rule from being implemented. But it did get. It was to be implemented over a few stages, starting in 2017 and finishing in 2018. The Fifth Circuit Court of Appeals this past week ruled that the rule was too broad, it affected too many people, it affected too much of the market, and so they blocked the rule from happening. The people that were for that, the people that wanted, that backed that, were the Chamber of Commerce, the financial services industry, which is geared toward and has a huge participation from banks, brokerage houses, and insurance companies. Those were the people that were paying the legal fees and supporting that through the appeals process. They'd lost at the first level of the court case, but on appeal, it got overturned. So, couple that with the fact that I have to share another example. Today seems to be a day of examples. I'd recently had someone approach me about taking over their 401k. When I examined the 401k, the mutual funds within the 401k were what are called R2 shares. You're probably familiar with A, B, and C shares. There's front load, there's rear load, there's 12B1 fees, and so on. In retirement plans, you can't have a front load. And in retirement plans, they set up different mutual fund categories on how they pay out by calling them R funds. So there's an R2, there's an R6. R6 are institutional shares. R2 shares are a rear end, a 12B1 share. So when this business was going to transfer and make me the financial advisor on the fund, the first thing that the fund company did is they sent out a comparison and said, this is what it's going to cost you if you convert from R2 to R6 shares. I thought it was quite the thing to send out to the business. And the first item on the whole thing, it said, it's going to cost you $1,000 more in setup fees to do the R6 shares as compared to the R2. A one-time deal. No, actually a yearly deal of $1,000 more. Every year, it's going to cost you $1,000 more. As you read through, and there was a whole list of items on this sheet, but there were only a few that really were significant. But one, over halfway down, was a comparison of the expense ratio of the R2 shares compared to the R6 shares. The R2 shares had an expense ratio of 1.39%, and the R6 shares had an expense ratio of 0.38%. So figure that out. On a $100,000 account, that cost you an extra $1,000 to have R2 shares as opposed to R6 shares. On $1 million account, it cost you $10,000 on the R2 shares as compared to R6 shares. Yes, you're paying an extra $1,000 to have R6 shares, but think of what is being charged on R2 shares. And that extra percentage, 37% goes to the financial advisor. So 2/3 goes to the fund company and 1/3 goes to the financial advisor. So on a $1 million 401k, it's going to collect an extra $10,000. The fund company keeps $6,300, and the financial advisor gets an extra $3,700 just for selecting R2 shares. You know, I'm a financial fiduciary. I have to make every decision in the best interest of my client. So I sent that, and I pointed that out to the company owner and said, if you compare what you're really paying, the $1,000 shows up at the very first, but if you look at it in a realistic basis, your participants, your employees are going to pay more. You're going to pay more because you have a good portion of the account, and I get paid more, but that's not the whole point. The whole point is the money should be going to the participants and to the owner for the amount that the owner had in the fund. You know, and that whole thing came out after the Department of Labor Fiduciary Rule. That whole thing is all legal and okay, just as long as all the shares in the 401k are of one class. So they all have to be R2 shares or R6 shares. You can't put some R6 and some R2. You have to make them all the same class. It has to be a level load. So there's a whole thing about who's a fiduciary and this idea of fiduciary. The Department of Labor rule is the Fiduciary Rule. And the SEC is about to come out with their fiduciary rule. The idea that some people have advanced is that registered representatives, the people that represent the big brokerage houses, the banks, and the insurance companies, need to have a different title than registered investment advisors. They need to have a title that does not include advisor. They can be financial consultants, they can be investment consultants, but they shouldn't be financial advisors. The pushback from the banks and the brokerage and the insurance companies is that'll give financial advisors, the true financial advisors, an unfair competitive advantage. Think about who gets the advantage when everybody's classed as a financial advisor. They only have the responsibility to see that it's a suitable investment, only have the responsibility to see that the shares are correct shares. They don't have a responsibility to choose R6 over R2. I do, because I'm a fiduciary, and every decision we make is in the best interest of the client. Has to be. That wraps up this. I'll be back next week with more. Have a very good weekend and a good week.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams, here on AM 1590. The Answer. The preceding program was sponsored by Adams Financial Concepts. The following program is sponsored by Adams